U.S. stocks advanced exponentially in 2017, extending a bull market as the Trump administration's tax reform agenda, together with solid economic growth and corporate earnings, has raised investors' spirits around the new year. The Wall Street has long had a tradition calling the last trading week of the year Santa rally, but experts saw another Santa rally all year round, fueled by the Trump administration's economic stimulus agenda.
Investor euphoria was ignited in early March following U.S. President Donald Trump's first address to joint session of Congress. He outlined plans for $1 trillion infrastructure investment, healthcare reform, immigration reform, and tax relief for businesses and the middle class. In result, the equities reached very important thresholds: 25,000 on the Dow Jones Industrial Average, 2,700 on the S&P 500, and 7,000 on the Nasdaq Composite Index, while the Dow has climbed up 25.22% so far this year. The S&P 500 and Nasdaq have risen 19.73% and 28.85% respectively.
Some analysts said that the absence of protectionist comments and the overall tone perceived as presidential instilled confidence among investors and sent equities higher and higher.
With all three major stock indices hovering at historical highs, investors started asking how much longer U.S. equities could rally. While investor optimism early in the year focused on the new presidential administration's plans for tax reform, infrastructure spending, and deregulation, the more recent exuberance finds support in growing corporate earnings, a strong international backdrop, and a steady dovish stance by the Federal Reserves.
The tax bill, the sweeping rewriting of U.S. tax law since 1986, would cut corporate income tax rate to 21% from the current 35% and lower individual income rates. In the last month of the year, the market focus was pretty much on how tax overhaul could translate into corporate earnings and the timing and the size of future adjustments to U.S. central bank's benchmark interest rates.
Fed officials said at its latest press conference that the central bank envisioned 3 more rate hikes in 2018. Market analysts and financial institutions had similar projections on the pace of interest rate hikes. Outgoing Fed Chair Janet Yellen said in her final press briefing that current high stock market valuations do not mean the market was overvalued or that a sell-off would pose much risk to the economy or financial system.
On Wall Street, sentiment is now a more important driver of the S&P 500 than fundamentals, and sentiment suggests there is still room for stocks to move higher in the near term. Wary of various risks, experts think that the Dow should continue to climb in 2018 in light of the recently passed tax legislation, likely a good sign for a continued strong equities market in 2018.